The situation in Europe, we're relatively relaxed. We're really not complacent about it, but we're quite relaxed about the situation. Back in April last year, as many people know, we were very concerned about the situation. That was pre any solution being put in place for Greece and then subsequently Ireland. But there is a solution in place. It's not a perfect solution at the moment. There's a lot of debate around the size of the Stability Fund and really the future and possibly debt restructures. We think it's inevitable there will be a debt restructure in Greece. It could happen sooner than people are contemplating. We were originally thinking maybe at the end of 3 years. It could happen sometime this year, but we're not concerned that that is really going to trigger a financial meltdown within Europe like we were concerned before any of these facilities and mechanisms were put in place. And they keep moving in a direction of improving some of the problems they've got. That doesn't mean it's easy. It's politically very difficult addressing some of these issues. There's a lot of noise going on. There's a lot of noise about Portugal and possibly Spain at the moment. We're watching it closely, but we really do not see a lot of risk for the global markets at the moment from what's going on in Europe. Well, the major macro risks we're focused on at the moment are actually geopolitical risks around the world. If we started in Europe, we'd probably be concerned about the political stability within Germany. We've got state elections coming up. They're not that determinative because they're not the federal elections, but they may be indicative of what could happen if there was a major change in federal politics in Germany to the extreme left or the extreme right. Some of these stability mechanisms being put in place that are very dependent on the goodwill of Germany and other larger nations like France, of course. But Germany is very, very important. So we're very focused on political risk of the major nations in Europe. The other area of the world that's obviously getting a lot of media at the moment is the Middle East. What happened in Tunisia, what's currently happening in Egypt. There is a risk that we could see a serious outbreak of hostilities or major civil unrest within the Middle East. We could see an increase in the Israeli-Palestinian situation. If that got to a situation that really infected the Middle East and caused a huge spike in the oil price, almost back to the 1970s, that would have huge ramifications for markets around the world. It doesn't look like that situation is going to develop at the moment. It looks like many of these governments are being changed pretty peacefully at the moment, but that's the main macro risk we'd be looking at the moment from a geopolitical situation. From an economic perspective, I think inflation and rising long-term bond rates is the major risk for investors looking forward. There was a lot of debate maybe 6 months ago debating that the world was facing deflation. We were very strong of the view that we thought that was very unlikely to develop, and we thought we were fast-forwarding, maybe not quite as quickly as it's happened, but fast-forwarding a year or so, and we think the world was going to focus on inflation. The emerging markets, inflation is really starting to pop its head. You've got inflation in the major emerging markets anywhere from 5 to 12% at the moment. It's at 5% in China. The Chinese, I think, are hopeful that it's largely food prices and energy prices, and they're hoping it's largely cyclical related to the production cycle. But if it's not cyclical and it's more structural, through the increase in demand for food and energy, and we have a genuine inflation issue with very high rising real wages in the emerging markets and rising inflation around the world, that is a paradigm that investors are really going to have to start to get their minds around in the next few years. It's something we've been very conscious of. We think it's very unlikely that central banks around the world are going to be able to keep inflation within the 2 to 3% bands that they've been aiming at in the developed world in the absence of very draconian monetary policy. That means much higher interest rates than we've seen recently, and certainly that we're seeing at the moment. And I think when the bond shock comes to many markets around the world, these long-term bond rates are going to jump very markedly, and that's a major risk for investors that aren't focused on it. We are very focused on that. We're really thinking about our portfolio of what will be benefited, what will be harmed by the inflation and rising bond rate story. And I think the probability of that playing out like we've been anticipating, the probability of it playing out like that is much higher today. I think there's a lot more evidence of that inflation and rising bonds than there was 6 months ago. Well, first of all, I'd say in significant changes, the portfolio actually hasn't had a lot of significant changes. Our turnover in our fund is very low, and what's inside the fund is entirely consistent over time. There's not a lot of fundamental changes going on in the portfolio. Half the portfolio is still these big multinational consumer staple stocks that we believe are very low risk and have a very high probability of delivering the types of returns we're aiming at, which is a 9% net of fees that are very exposed to the emerging market consumer. They're actually pretty well hedged against inflation because of their pricing power as well. Where we have made changes in the portfolio, we've added a little bit more discretionary to the portfolio, particularly relating to a US economic recovery that we've been anticipating for some time now. And we bought a position, maybe a 6% position in the fund, in a home improvement retailer known as Lowe's in the United States. It's really a duopoly between another business called Home Depot. Lowe's is the new business partner for Woolworths in Australia, and they're going to roll out a Bunnings equivalent in this market. And I think when we start to see those stores and see how Lowe's goes about their business, I think Australians will get a much better feel for really the quality of this operation. So we're very happy with that exposure. We have actually decreased our exposure to the big card payment networks, mainly around some regulatory risk, around some legislation that has been passed in the United States. We still have exposure in that sector. We still think it is very well positioned for the long term, but we're very risk adverse, and as we saw more risk in the sector from a regulatory uncertainty point of view, we've just held back a little bit on that sector at the moment.